Have you ever thought about how you could amplify your investment returns without actually depositing more cash? That's the power of margin, borrowing money from Wealthsimple against your existing investments to increase your buying power. It's an incredible tool for experienced investors, but like any powerful tool, it comes with risks, the biggest of which is the dreaded margin call. So, how do you use Wealthsimple's margin responsibly and steer clear of that financial emergency? Let's dive into the best practices to help you leverage your portfolio smartly. 1. Understand your numbers. The absolute first step is to know your account health. Wealthsimple makes this easy with their margin health tracker. This tracker gives you a clear picture of whether your account is in the good zone or getting close to a margin call. You need to keep your margin available balance above zero at all times. This is the amount of equity you have in excess of the maintenance margin, which is the minimum value your account must maintain. Best practice: check your margin health daily when you have active margin positions, especially after market swings. Wealthsimple does send alerts, but the ultimate responsibility is yours. 2. Limit your leverage. Just because you can borrow the maximum amount doesn't mean you should. Margin is essentially leverage, and leverage amplifies both gains and losses. If you max out your margin buying power, a small dip in the market can quickly erase your cushion and plunge your account into a margin call situation. Best practice: only use a fraction of your maximum available margin. Leave a substantial cash or securities cushion in your account. The larger the cushion, the more volatility your portfolio can withstand without triggering a call. 3. Diversify your holdings. Concentrating all your borrowed money into one or two volatile stocks is a recipe for disaster. If those specific stocks drop sharply, you lose your capital and you still owe the brokerage the full loan amount plus interest, all while facing an immediate margin call. Best practice: diversify across different sectors and asset classes. This helps ensure that a sudden downturn in one security doesn't decimate your entire collateral base, making your account more resilient to market turbulence. 4. Be ready to fund fast. A margin call is your broker's demand for you to deposit additional funds or sell securities to bring your account equity back up to the maintenance margin. Margin calls are payable on demand, and the deadlines are typically very short, often by the end of the next trading day. Best practice: have a liquidity plan. This means having easily accessible cash outside of your margin account or knowing which positions you are willing to sell instantly if a margin call occurs. Don't rely on selling illiquid assets or waiting for a bank transfer to clear. Wealthsimple even reserves the right to liquidate your positions if you fail to meet the call, so speed is crucial. Summary of success: margin can be a phenomenal tool for compounding your wealth, but it demands vigilance and a conservative approach. Understand your minimum requirements, use leverage sparingly, diversify your risk, and always be prepared with a plan for a quick funding injection. Master these Wealthsimple best practices, and you'll be trading with amplified power, but with a disciplined approach that keeps the broker happy and your portfolio healthy. With that said, thanks for watching, and until next time.